Certainly it looks like GDP growth is actually on par with previous upswings that we've seen. Consumer spending is actually a bit stronger. Despite concerns about consumer spending going forward, I don't think there's going to be a collapse in consumer spending, given that after-tax income growth is still healthily above inflation numbers. So that is certainly a boost for consumer spending. Yes, on the other hand, consumer credit growth is very slow, so that's an inhibiting factor. So consumer spending is stronger than in previous cycles, and yes, therefore, fixed investment spending, as we expected, is a bit lower than in previous cycles when you compare those cycles. And it's not only from government side, not only from public corporation side like Eskom and Transnet. In fact, they're starting to spend again. It's also from the private sector, and the private sector heavily impacted by sentiment, of course.
And cautious, like we're seeing
very cautious
all over the world with companies.
Yes, we do see some signs that both public sector, government and the public sector corporations, and even now the private sector, we see signs that they're starting to spend a lot more. One of the best indicators of that, or two of the best indicators, machinery imports in US dollars. That's been rising rapidly. That's a good leading indicator for private sector fixed investment spending. Also commercial vehicle sales, that's been picking up quite nicely. Another leading indicator for fixed investment spending. So I certainly think the cycle will now start building.
You touch on inflation and keeping inflation stable and low. At this point in time, inflation is below 6%, but we are expecting inflation numbers out tomorrow. What is your forecast over the longer period for inflation, and do you feel that inflation is under control?
Well, to be honest, I don't think inflation is under control yet. The Reserve Bank has been doing an excellent job in doing the utmost to keep inflation under control. But unfortunately, they cannot control lots of factors. They cannot control food prices, the international oil price, the rand, they cannot control. There's lots of administrative price changes that they cannot keep their finger on. Electricity price changes, for instance. Water tariffs are going to be the next big thing. So there's lots of things within the inflation basket outside of the control of the Reserve Bank. So in the medium to longer term, I don't think we must expect 3% inflation in South Africa. Rather work around 6% inflation. And within that, the Reserve Bank will continue to do their utmost to keep it under control.
So a lot of those factors influencing inflation exogenous and really out of the control of the Reserve Bank. What does this all mean for the interest rate cycle?
Well, on the short term, we expect inflation to peak out at just above 6%. Maybe end of this year, maybe early next year sometime. So on that basis, and the fact that the local economic growth environment isn't booming, around 3% growth for the next year or two, we expect interest rates to remain flat where they are now, roughly to the third quarter of next year, when we should probably see an initial hike in the cycle. But we still expect a very muted interest rate cycle. In other words, very muted increases going to come through. We don't subscribe, as you said, to the fact that interest rates can potentially be cut unless there's a significant global and thus a local economic slump. That's an outside chance scenario. It's not the base case. The rand, of course, is crucial in all of these assumptions. We do expect the rand to stabilize, given that our fundamentals are still so much better than everybody else out there, virtually, and the fact that recent moves in the rand has been on a risk aversion basis. And once the Europeans sort out their problems, we think the rand will stabilize again.
So just to sum this all up, you're expecting a soft landing in China, a mild recession possibly in the Eurozone, and no recession in the United States. So global growth is expected to be slower for longer. The question is, how long?
Yes, sustained sluggish growth, but I think...
For how long?
Volatility for many more months is the best answer that I can possibly give you. Because maybe the Europeans come out with a package, but maybe there's some further issue that comes to the fore, like Italy, like Spain, like one of the others. So I don't think, even if the Europeans come with a decent package within the next week or two, three, in terms of recapitalizing banks, haircut on Greek debt, decent policy plans, I don't think it's over yet. I think markets will still be worried about what's going to come. So expect continued volatility and therefore be very careful in terms of your investment decision making. But I think I stick with a slow growth scenario rather than a growth slump scenario.